Hi everyone, welcome back to the HFAC comp. Over the past few weeks, we've started a discussion onto what makes a good business in a qualitative sense, and then last week we looked at how to find financial statements from the SEC website and from FactSet. But now we really want to understand what those financial statements mean. How do you come up with a financial statement? What are the different kinds of statements? So over the next few weeks, and this is going to be our second unit, we're going to be looking at the three major financial statements: the income statement, the balance sheet, and the cash flow statement. However, there's a core principle that we really need to understand for accounting, which will help explain all these statements, and that concept is accrual accounting. Now, accrual accounting, I think, is best explained by example. So let's jump right in. So let's say you're the chief financial officer at Airbus, an airplane manufacturer based in France. On December 31st, 2019, Airbus receives a huge order from Delta for their most popular plane, the A321neo, and you can see a picture of it there. So Delta puts in an order for 100 of these aircraft, each with a price tag of $102 million, US dollars, and this gives a grand total of $10.2 billion US dollars. Delta has a lot of cash on hand at that time. They're investing heavily into their business. So they pay in cash immediately, so they don't need to pay later, don't need to pay any interest on any debt or anything. So they pay the cash immediately and tell you that they want to receive their planes over the next 2 years. So your shareholders will be thrilled at Airbus, right? You received $10.2 billion, which will make up like 10% of your annual revenue, so that your annual revenue just increased 10% compared to last year. Does that make sense here? So pause the video for a second and try to think about if that statement where your annual revenue has increased 10% makes sense or it doesn't make sense. Great, welcome back. Hopefully you thought about that a little bit and thought that was a little fishy. Like if you make 10 of these orders, you will make 100% more annual revenue. That doesn't really make any sense. So this really breaks down into the two types of accounting methods we have: cash accounting and accrual accounting. We can usually touch cash, so that's why it gets its own method of accounting. But there's some cases when we can't touch cash. So accounting doesn't just track the cash position of a business, and not all cash changing hands is recognized as revenue, and not all revenue involves cash changing hands. To differentiate between what counts as revenue and what doesn't, accountants have invented accrual accounting. So the previous example we saw was cash accounting, and now we're going to discuss accrual accounting, which doesn't necessarily tie events with the cash position of them, but really on the economic event. So accrual accounting is an accounting standard that measures the performance of a company by recognizing economic events regardless of when the cash transactions occur. So how does it measure performance? It measures performance by the matching principle, which matches of revenues to expenses when the transaction or economic event occurs. So let's continue with this example. So you know that as the CFO, you won't be adding another $10.2 billion to your company's revenue for the 2019 fiscal year. So remember, they received this order at the end of 2019, but you're not going to put the $10.2 billion in the 2019 fiscal year because you know that you're not going to deliver all the planes immediately. You're going to deliver 50 planes in 2020 and 50 planes in 2021. So how are we going to mark that? Remember, in accrual accounting, we mark it when economic transactions occur. So pause the video for a second here and think, how much revenue are we going to book in 2020 and how much revenue are we going to book in 2021? Okay, so welcome back. In 2020, we will book $5.1 billion in revenue to reflect the delivery of 50 planes that year. You'll also recognize all the direct costs associated with building those 50 planes. So maybe it takes more than a year for a plane to be built. But even if you've spent money in 2019 to start building those planes, you're not going to book the direct costs with those aircraft until 2020. You might have given the cash to like Rolls-Royce for the engines, but when the plane is actually delivered, that's when we're going to mark the cash for those engines there. So now what's going to happen in 2021? The same thing is going to happen. We're going to deliver the next 50 planes, and we're going to book $5.1 billion in revenue, and then we're going to also recognize all the direct costs associated with building those remaining 50 aircraft. Again, it takes more than 1 or 2 years to build an airplane sometimes. So even though we might have been spending money, actual cash might have been getting transferred from Airbus's bank accounts to some of their suppliers, we're not going to book or recognize those direct costs until that economic event of delivering the aircraft actually occurs. So this is what's different from accrual accounting and cash accounting. Accrual accounting is recognizing when economic events occur, while cash accounting is just recognizing when the cash changes hands. At the end of the day, accrual accounting is a little more useful because it can help us determine the actual economic activity of a business. So to summarize, the TLDR here, we want to record transactions when economic events occur, not necessarily when cash changes hands. And that's pretty much all it is to accrual accounting. We'll see over the next few videos how we incorporate accrual accounting into our income statement and how it plays a role on the balance sheet, on how we sometimes book transactions where we might have received cash, but we haven't necessarily received or delivered a product yet. So we'll see you in the next video for the income statement.